Hi, everyone. Good evening. I am Ritesh. As Melvin mentioned, I head the investment advisory team at Syfe. Don, welcome to today's session. Thanks for joining us today. Thanks again, like you've joined us previously as well. And we've always enjoyed our conversations with you, especially given that, you are very much involved in the whole finance, investing, and in general, sort of disseminating your knowledge in terms of your own experiences with investing broadly as well, right? So I think core satellite investing is a framework that has been espoused by a lot of finance professionals. This is a strategy used by a lot of investors to really maximize their returns, but at the same time, invest in a more responsible manner. So I think, you yourself are a big proponent of core satellite investing. So we thought that this session will focus on what core satellite investing actually means and how do investors actually can implement such a strategy through the different investment options that are available in the market. So what we'll do is potentially, if you could start by giving a little bit more, better understanding to our viewers today as to what core satellite investing actually means and how can, an average investor implement their own core satellite investment framework, right? So I think let's begin with that. And maybe what we'll do is, post that we will go and cover a little bit about Syfe, our introduction, the different portfolios that we offer, and how can actually an investor on Syfe platform implement a core satellite framework through our different products as well. So let's hand it over to you. Let's begin with a quick introduction about the core satellite investment framework, and we'll move accordingly.
Hi everyone. So my name is Dawn. As you guys probably may know me, I also run by the acronym SG BudgetBabe online. And in my whole investment journey, there's been a lot of different strategies that I've explored. There's stuff like, the permanent portfolio, there's factor investing, there's also like a simplified way would be the coffee can portfolio. And there's just so many different strategies out there that you can apply. But I think, with the recent rise of the technology stocks especially, there is this danger whereby if you don't actually have a holistic portfolio strategy, that could be really dangerous. And in a lot of the research and the different strategies that I've come across, I truly believe that the core satellite strategy is one of the more superior ones. That's also why, like Ritesh, you mentioned, it's one that is frequently espoused by many financial advisors, even private bankers and relationship managers, except that you usually would have to pay them a hefty fee for the advice and execution. So the good news is, in today's webinar, you're going to learn what exactly is the strategy about, as well as the different methods that you can use to execute this in your own portfolio. And we'll talk about the DIY approach, the assisted approach, as well as the more passively managed approach. Let's get started. So I'll go on to next. So what exactly is core satellite? So in theory, right, it's pretty simple. Your portfolio is all about having a strategy across all your different asset classes. And you need to have a strong core. And just like how any foundation needs to be strong, this is where your core similarly needs to be strong. And one way to do this, for example, is through global equity. So you get exposure to investments in companies and businesses around the world. And you also get exposure through bonds, which are more risk-free investments, as well as through gold, which typically hold up the value over time. So that basically would then form a very strong base, a strong core per se. And then the satellites are kind of like the revolving planets, right? And what you do is you use thematic approaches to run your satellite. And in this picture, we've only basically done 2 satellites, but the truth is you could do as many satellites as you wanted to. For example, if you wanted a core of, say, 1 core and 2 satellites, then if your satellite is, say, in this picture, what I've done is a real estate satellite. Right? So you believe that real estate will increase in value and it's a really good investment tool to have for the future, then you could build one satellite in real estate and the other one could be in growth companies. So companies where you see them playing a really big role in the future, for example, in digital payments, in technology, and basically whatever team or approach that you think is going to be the central team moving forward 10, 20, 30 years from now. And you could build more satellites if you wanted to, like, in healthcare or in commodities, transport, whatever you want. But let's go with a simplified version first. What if we did core and 2 satellites? So I think the thing I really like about Syfe's approach is that before choosing any robo-advisor, right, I think it's really important to kind of understand what is the strategy that you guys are using, and if that's something that I can personally execute, or I would personally choose to execute. Because if it's not, if that's not aligned there, then I'll be better off doing it myself or finding someone else who goes by the same values and beliefs that I do for my investment, and then putting my money there, right? So I've only used 1 core and 2 satellites, and I think the good thing is that you guys, with your recent launch, you actually have a way for someone to execute this 3. So I'll hand it over to you. Ritesh, would you be able to share more in terms of what is your view? Why did Syfe choose the core satellite investing? I mean, so many strategies out there. You came from banking as well. You mentioned you're previously one of the Wall Street investment banks, right? So why did you guys choose this approach, and how do you see this as being superior for your investors?
Oh, absolutely. Thanks. Thanks for the coverage on the core satellite framework in general. And as you rightly covered it, your foundation needs to be really strong before you can take extra risks with your money, right? So at the end of the day, psychologically, as well as when investors are putting money to work, one of the more biggest concerns that investors have before they go into the market is like, if I put money into the market, what if the market tanks and I lose, right? That is like a perennial doubt that like affects a lot of us, and especially in Asian context as well as in Singapore in general. There have been a fair number of research and data that has been collected where the outcome of it was, we as Asians and we as Singaporeans, we are really good at saving, but when it comes to investing, we don't really optimize for it. And because of that, in terms of when you're looking at your long-term goals, whether it is retirement, whether it is looking for your children's education, or other goals such as buying a house, these could be hard to sort of get by. And maybe you want a certain sort of lifestyle, you want a certain retirement income to come in. All of those cannot be achieved if you don't invest very responsibly and if you don't have a strong foundation at the first place. And that's why I think when people think about investments, either they are like, what can you give me and what is the maximum return that I can generate? Like that tends to be a lot of focus. Plus, the other side is the fear of investing, right? So to cater to both those aspects, I think the core satellite approach becomes like a very good way for people to think about investing without taking risks beyond their capacity. Because when you do a core satellite approach, your bulk of your money goes into a very stable, steady investment, and it ensures that your journey to your goal is very smooth, right? So that's number one. Like if you invest bulk of your money into a very high risk investment on day one, and if suddenly there is a big market correction, that's where people panic and they sell out, and essentially they're not able to achieve their goals. But if you have a strategy like this is where I think the difference comes, where most of the investors, if you look from a long-term standpoint, they're not really there to sort of I want the best possible returns and I want to beat every benchmark. They are really there to achieve certain goals, right? And that's why I think your investments should align to those goals. And what that essentially then means is your portfolio should be fairly diversified. It should be risk managed, and that will ensure that your journey towards the goal is very, very stable, right? And you don't get like disturbed or taken off the road because of certain market fluctuations per se. So that's, I think, the core tenet of having a core satellite approach, where bulk of your money goes to this foundation. But at the same time, we, all of us as investors, have certain views, we have certain preferences, and we want those to be incorporated in some way or the other. And that's where the satellites come into play, where you can incorporate, like you have a view on, say, China, or you have a view on a real estate, you have a view on technology. You think artificial intelligence is the next big thing. That's where I think all of these satellites come into play, where they are high risk, high reward kind of investments, right? So whether they will either make you like multiples of money, or some of them can really tank as well. But the fact is, if you invest responsibly and wisely, where a small portion of your money goes into them, that's where your broad level goals don't get disturbed massively, right? So I think that's the overall framework why we, highly encourage folks and investors to have this core satellite approach. And it takes care of both the aspects that I mentioned about, like, going after returns, but, the fear of investing also taken care of.
Yeah, I think you raised a really good point as well on how, like, you could be wrong on some of the teams. And if you don't actually strategize it right, then it could be really problematic, right? So I think, everyone's always talking. We see a lot of articles talking about how, if you invested X amount of dollars into the S&P 500, you would have gotten this amount of money. But fewer people say the same for, let's say, the STI index. And there are some other indexes that, just very frankly speaking, haven't done as well as the S&P 500, right? Even S&P 500 right now, a lot of that recent growth in the last decade has been driven primarily by the big tech or the FANG companies. So if you were to take that out of the equation, when would they continue growing at the rate that they have been in the last few years? And if someone were to only go into the S&P 500 because of all these, articles and general advice that's going around, that could also be problematic, because the other side of the story that they are not hearing is that there are also so many multi-baggers. And some of them are not in the S&P 500. Like, I have to be disclaimed first, I'm not an investor in Tesla, but I have been following with a lot of interest all of the YouTube videos and people sharing their views on Tesla. And, I think those who have been in Tesla, who had the guts to be in Tesla, the vision, whatever you want to call it, if they had gone in earlier, it's undeniable that Tesla has gone up by a huge percentage. And S&P cannot beat that. Right? And if you have that kind of view, if you have a strong conviction that this thematic sector or this company, or even that, like you mentioned China, I'm super pro China. I believe they're going to be a very strong economy for the future. But in the same reason, I believe India is going to be another very strong economy to be reckoned with, but maybe they would need a little bit more time to reach that stage. So with all of these themes, we can actually incorporate it in the satellite. So you don't actually have to give up on the potential multi-bagger returns, which a simple ETF cannot give you. But at the same time, having that kind of global exposure in the core ensures that you can at least still manage your risk accordingly, and most importantly, you can sleep easy at night. So I think that's great that you guys also espouse the same value, because anyone putting their investment in any solution, be it a digital robo-advisor or even a private banker, if everything was to be only in satellites, then that's going to be really worrying, right?
Exactly.
Imagine the tech crash last week, people would be like fretting out, and I don't think they would have had a lot of sleep.
Exactly the point. And I think I have like one more example, and I was literally just watching something when it came up. Think of all the meals that you have on a day-to-day basis. Would you on a daily basis have meals like which is really great tasting, but not really great for your health. And potentially, like, if you keep having the same stuff all the time, you expose yourself to a risk of, that particular meal having adverse impacts or side effects for you. So when you are thinking of a balanced meal, you do want your carbs, you do want your proteins, you do want your like tasty stuff as well. So that's why, like, when you're thinking about your core part of your portfolio, the bonds give you that stable cash flow. Gold acts like, an investment that takes care of uncertainty in the market, and as sort of an inflation hedge, or some sort of a way for you to counter, like, USD, say, currency depreciation in these times. And at the same time, the equity continues to give you that growth, right? So that's where I think the balance comes in when you're thinking about your core. And then on top of it, like, you think about your desserts, your other things, something, you really like, spicy food, for example. So really, if you want to incorporate those aspects into your investments as well, that's where the satellites come into play. So I think it gives you a very good understanding that, like, similar to how you want to, keep yourself healthy and fit and fighting, your investments need to have those same, elements incorporated if you want them to really generate you long-term wealth in a very steady and stable manner.
Mm-hmm. So, Ritesh, walk us through, in the past, it wasn't actually feasible to execute the entire core satellite investment strategy with Syfe, because when you guys first started offering your solutions, of course, it was bit by bit, right? So a lot of it in the beginning was like you had one piece, but not the full thing. So it was very hard for anyone who really wanted an entire portfolio strategy to just find one solution provider and stick with them. But I think that's what made your recent launch so exciting, the Equity 100. So yeah, could you walk us through, your different solutions? How do you execute the core satellite investing based on Syfe solutions? And why do you think that's a superior option? And once you're done, I'll talk about how we can compare it to the DIY approach or even your own ETF selections approach.
Absolutely. All right. So let's actually cover some of the products that we have, right? So, broadly, I think alongside the core satellite approach, we are very, very conscious in terms of, the kind of portfolios that we want to, give out to our clients, yet, not be, like a big menu item where you just get lost, like, what do you do and how you do and stuff like that. So I think broadly, we try to address two big aspects or objectives when it comes to investing. People typically want to either grow their wealth for a certain goal, like a dollar value, or they want to, generate some sort of a passive income, right? So those are like two of the key goals that, generally investors have. And that's where if you look at the different portfolios that we have on offer, it sort of covers all of those aspects per se. So on the left-hand side, you see the global portfolio. So as we covered earlier, when you're looking at a core allocation, you really need a very diversified, multi-asset class, geographically diversified portfolio as well. And that's what the Syfe global portfolio offers, where it is like a mix of equities, bond, and gold. The proportion of equity, bond, and gold varies depending on what risk level you are comfortable with. So typically in our global offering, we have 11 different portfolio options within the global framework. And the idea for these different risk levels is that depending on what your investment horizon is, depending on what your goal is, and depending on what your capacity and sort of risk appetite is, you can choose a particular portfolio that suits you and aligns you to all of those aspects. And that's where I think, and the way we do it is also very unique, where we don't just, create portfolios with, oh, this is a moderate risk portfolio, so take 60-40. This is a aggressive risk portfolio, take 80-20. We really want to quantify the amount of risk that you're taking. And what that means is, instead of using those vague terms, what we use is, these quantified numbers that we call downside risk or drawdown risk. And what you as an investor on day one then chooses, what is the maximum drawdown that I'm willing to take on my portfolio, and I will not panic and sell out, right? So that, I think, psychologically is really important, because I think that's, again, going back to my point, why do we have so much money, stashed in our bank account rather than investing beyond our emergency fund? It's because we fear of losing. But if you roughly know that your maximum downside is sort of capped to a particular level, and then based on that as a constraint, we try to maximize your return, you will be much more comfortable investing your money in the first place. And you know that your money will be safe, stable, and will overall, give you a smooth journey to achieve your goals. So that's where I think the global portfolio comes into play in terms of, growing your wealth, but at the same time protecting your downside. The Equity 100 portfolio really came about to, give investors the choice to invest into the stock market, into the broader equity market, as an alternative to themselves sort of picking a particular stock or ETF and deciding which ETF to buy or which stock to buy, what proportion to buy, and how to rebalance it. Again, there is a lot of implicit cost involved in thinking through what is the right strategy and how do I design my equity portfolio to grow over time. So rather than, again, be subjected to our own emotions and biases and stuff like that, we follow a very data-driven approach in terms of having a smart beta strategy. And I'll go over it maybe a little bit later in terms of what that entails. But to really focus on certain factors that drive returns to your portfolio. And that's what I think the Equity 100, tries to do. It is really to maximize your returns. And that's why, we espouse that, use Equity 100 as more of a satellite. But, given that a lot of our investors are professionals who have a monthly income and they have monthly savings, there's also a portfolio where a lot of, our clients love to do dollar cost averaging, right? So this is, a combination of, I think, the global and Equity 100 really helps a lot in terms of designing your overall growth portfolio, where a bulk of your portfolio remains safe and stable, especially if you're looking to deploy lump sum amounts. But at the same time, you can deploy maybe a smaller amount to begin with into an Equity 100, but your monthly contributions can go into this to average out your risk, right? So I think that's where I think these two portfolios work really well together. And then I think, the Syfe REIT Plus portfolio is really, a portfolio which is very unique to Syfe. No, I think our, competitive platforms have this kind of a portfolio. It is really a very popular portfolio as well within this region. And I think one more very important point is this is built in partnership with the Singapore Stock Exchange, where they have licensed this index to us, which is called the IHSG Leaders Index, which gives you exposure to some of the top blue chip REITs in Singapore. And by virtue of investing into REITs as an asset class, I think just for the benefit of everyone who doesn't know a lot about REITs are typically pools of properties that you invest in. The rental incomes that come in become the revenue for these particular investments. And typically REITs are regarded as somewhere between stocks and bonds because they have elements of both. And by law, they are required to give out 90% of their quarterly income as dividends to the shareholders. So a lot of older investors love to invest into REITs from a really passive income generation standpoint because they can really depend on those quarterly payouts to come and all. And a lot of young investors actually invest into REITs from the standpoint of investing into a Singapore dollar portfolio, and they reinvest the dividends to grow it over time. And if you really compare the REITs performance against, as you mentioned, Don, with the STI index, REITs have far outperformed, the equity returns that you get locally in Singapore. So when you're looking at options to invest your Singapore dollar, I think REITs become a very, very, attractive asset class to sort of invest as a young investor. Just build your exposure, and maybe, you have a goal, say 10 year down the line, 20 year down the line. I want to have sufficient amount invested into REITs such that I generate, say, $1,000 a month or $2,000 a month, right? So that is how we have structured our investments to make sure you get the global exposure, diversified, risk managed, but at the same time you do have these options to express yourself, whether you want to get into a more high growth sort of sector exposure, or you want to generate some sort of a passive income over a longer horizon. Does that make sense, Don? Don, I think you're on mute.
Yeah, okay. Yeah, it does. And I think for those people who are not familiar with your solutions, maybe I can try attempt to simplify that further. So you see, you can choose from different ways on how you want to execute the core investment strategy in your own portfolio, right? And, I talk a lot about DIY investing, choosing your own. So one way you could do this, for example, is that you could build selections of, say, government bonds or low-risk corporate bonds that you believe are reasonably safe to give you that exposure. For gold, you could go with, either buying physical gold or even gold certificates, or even your actual gold jewelry if you're into that, or even like a gold ETF, right? And then if you want to execute the global strategy, what you could do is to go with a global ETF like the S&P 500. You could also go with other different global ETFs. If you don't want the S&P, there are Vanguard and there's BlackRock. There's just so many options out there that you could invest into. And then if you wanted to execute the equity part, so lots of people, maybe they already have the other portions in other assets, right? So say, for example, someone who invests very strongly in property. So property might be a huge part of his portfolio. He doesn't really need the Syfe REIT, for example, that's over exposure to just one asset class. So what he would do is he could use the Syfe Global or the Syfe Equity, or even say if he has already set up his Syfe Global, his global portion, right? Maybe he has actual physical gold. Maybe he has land, and all of that is very much personalized. So I think these three options as standalone are great add-ons to anyone's portfolio, because instead of having to identify each of the different solutions by yourself, buying into them and managing them all by yourself, which takes time to research, time to purchase, not to mention you have to keep paying your commission fees each time. And at the same time, having that discipline to not sell off when things are going bad. I think there's a lot of elements in investing. If you go through that DIY approach, you have to make sure that your personality and the amount of time that you have makes sense. And on top of that, their costs also come in. For anyone who's starting to invest, I always say if you want to start investing and your capital sum is very small, it doesn't really make sense to go as a direct DIY investor straight away, because you need to have a minimum sum per investment in order to actually make the commissions make sense, right? We try to keep it below 1% as an average gauge, but the truth is the lower it is, the better. And if you have only say $3,000 to invest, and you want to execute this to have your core, your real estate, your equity 100, whatever else that you want to invest in, it's really hard to get access to so many different solutions with just $3,000. And say if you were to divide that into 10, right? Say you choose S&P 500 as one, you pick 3 REITs, and then you pick 4 growth companies that you're really bullish about, so that's 8. And then you pick, like, say, 1 gold ETF and 1 other, I don't know, like a China ETF or something. Buying that 10 itself is going to cost you quite a sum of money in commissions, and you're only having $300 in each of them. So that just doesn't make sense, right? And on top of that, you know, having to manage that, if you don't actually remember to rebalance it, to add on to it, then that's not going to be very good for you in the long run. So for folks who need something to add on to their existing portfolio or start that whole core satellite portfolio itself, that's where I think you guys, this solution is really great, because you don't have enough money. Well, you can buy like access to fractional shares in this case through your solution, because $3,000, for example, is not even going to get you Berkshire Hathaway. But you can get exposure to that through Syfe Global as well as Syfe Equity 100.
Absolutely. Yeah. So I think, like, you know, especially for smaller ticket sizes, you know, it's an absolute no-brainer. But even for, like, you know, bigger investors, what we have seen is people simply don't have the time to sort of, you know, go through the hassles of picking and choosing and, you know, spending time and being on top of the markets. So, and, you know, given how scalable our platform is and how competitive our fees are, I think for that level of, you know, personalization that you get, for that level of value add that you get, a lot of clients are really happy to pay, you know, the kind of fees that they're paying, given that they actually don't have to separately pay any transaction charges, rebalancing fee, there is no exit fee, and essentially all dividends and all are reinvested automatically, right? So, you know, there are a lot of benefits when you invest into a platform which, you know, is built to scale. And as we scale, we will continue to sort of enjoy economies of scale as well. And what that means is we can pass on those benefits back to our clients as we progress, right? So I think those are very, very important factors. So like, you know, for example, our REITs portfolio on a standalone basis, you compare it with any other ETF. Usually a lot of people compare our REIT portfolio with a REIT ETF because we do track an index, just that we have not launched it as an ETF, but it acts, you know, almost like an ETF. And you consider how much cost it will be for you to buy a, you know, REIT ETF where they have their own management fee or expense ratio, which is roughly like 0.5, 0.6. And then on top of that, you pay brokerage fee, custody charges. And if you have dividends coming in, you try to reinvest the dividends. You get $100 dividend. You want to reinvest, you get slapped with like a $20 minimum brokerage fee, right? Doesn't make sense at all, you know, and you know, this almost is like, again, sort of a non-brainer to then consider as an alternative for you to get started.
Yeah, I'm gonna ask a hard question on behalf of the in the Q&A. So yes, that's a really great point, right? How would one compare between Syfe REIT Plus and Lion Global S3 ETF? I think you already mentioned some of those, but if you could go back to some of those elements, that would be great.
Absolutely. So, I mean, I don't want to take the name, but essentially, if you go with any REIT ETF in general, you end up sort of paying a management fee to them. And roughly, there are 3, I think, REIT ETFs available in this part of the world. And typically, their expense ratios are between 0.5 to 0.6%, I think, on average. On top of that, you end up paying a brokerage fee, and the average brokerage fee for buying into the local Singapore market is roughly around 0.2%, if I'm not mistaken, with a caveat that there is a minimum brokerage fee of $20 or something on those lines. So again, if you're starting small and you want a diversified REIT portfolio, when you invest into a REIT ETF, you will end up paying close to, you know, if not 1%, very close to 1%. On a total basis because of, you know, the annual management fee, the brokerage, the annual custody charges, trustee fees. There are a whole lot of these fees that are embedded within your investments, and not to mention the liquidity and bid-ask spreads and stuff like that of these ETFs themselves, because they trade on the exchange. And if there is not sufficient liquidity, there will be a big bid-ask spread that you will pay buying into these ETFs. Versus in our case, we actually buy the REITs themselves directly, right? So you actually hold the underliers. And because the REITs themselves are fairly liquid, at the end of the day, you're only paying us, depending on what sort of tier you fall into, between 0.4 to 0.65%. And that's all inclusive, right? There is no brokerage cost. There is no custody charges or trustee charges and things like that. And, you have a nice options such as your dividends are automatically reinvested. And think about it, 5% dividend yield that you get from your REIT investment, if it is lying in cash versus it getting reinvested. What we found out as, one of our research is that the 5% that gets reinvested on a periodic basis, it actually contributes another 0.5% returns to your portfolio, right? So in a way, our REIT portfolio sort of pays for itself, because the 0.5% that you're paying us or 0.4% that you're paying us, you're more than covering because of just that one feature of dividend reinvestment.
Exactly. Right? And I think another point is that not everyone always reinvests the dividends. The truth is some people take it to go on a holiday or stuff, right? So I think what you say is spot on, whereby for those of you who are still struggling to try and figure out how exactly it differentiates between these ETFs, that was also my question before I started working with Syfe, to really understand their product. And I think there's this simple analogy that you can use. In a typical investing sense, when you do it by yourself, you are like the one who owns the investments, and then you have to buy it through, let's say, a ETF manager, a fund manager. They're the ones who have your ETF, and then you also have to pay the brokerage, and you have to manage that whole owning through your brokerage yourself. But through Syfe, it's kind of like combining both of them in one, right? Whereby you basically have you guys are like the brokerage as well as the ETF for the fund manager in itself, and you're only paying that one fee without having to do the rest of the work, like buy and sell, reinvesting your dividends by yourself, which you would need to do if you had done the DIY. So yeah, this slide is the one that we were talking about in our last webinar. I think this really breaks down, and I hope that addresses your question for the one who asked that, as it was anonymous. I can't name someone, but this is a great way to think about it. There is significant differences between doing it yourself. Is DIY, you still need to buy through an ETF, right? If you want multiple REITs, unless you're talking about buying each of the REITs individually. Though if you want to have to combine that ETF plus brokerage all in one, Syfe basically does all of that for you. And in terms of the fees, I think you're spot on. It's pretty no-brainer in that sense, because the kind of effort that you're saving is tremendous. And for people who are not disciplined and always go and use your own dividends for your holidays or something else, right? You're like telling yourself, I need to reinvest that because I know it will help my returns. But the moment the money lands in your account, you withdraw it and you go and reward yourself with something else. If you need that kind of discipline, you can't do that with a ETF.
Exactly. And you have the choice with us, right? You can, actually pay it out to your bank account or reinvest it. The choice is definitely there, but I think a lot of younger investors, they do take that choice of reinvesting the dividends because they're really there to grow their, sort of wealth right now through REITs and in, non sort of currency risk standpoint, right? So because it is Singapore dollar denominated. And then, again, as I said earlier, people typically have these goals of, generating an alternative source of income by age XYZ. And it works really well for them.
Yeah. So, okay, we have a lot of great questions in Q&A, which we'll come back to. But I think we want to talk about risk, right? Because one other differentiator in the Syfe approach is that you guys have built in risk management into your whole philosophy. So, Ritesh, can you tell us more about this risk approach and how did you guys incorporate that into your solutions?
Absolutely. So I think risk management is like a core tenet of, Syfe investment philosophy. So I think one thing that we always tell our clients is, returns is something that cannot be guaranteed, but risk can be managed. If someone is telling you, for example, gives you two choices that, okay, I can generate you say 7% return versus another person tells you I can generate you 10% return, without any other context, you will obviously sort of go for the 10%, right? Like, you get bigger returns, why not? But if that same, sort of two choices are given to you, but it is now, caveated that, okay, you can get the 7% return, but by the way, in a worst case scenario, you can lose 15% as well. Versus, okay, I can give you 10% return, but in a worst case scenario, you can actually lose 30%. Now, will your answer be the same? And that's where the whole paradigm of risk management comes into play, where you invest according to what your risk appetite is, and rather than concentrating on returns on a standalone basis, you actually invest according to what your risk appetite is, and as long as you can control your risk, the returns will come, right? So I think that's like the overarching framework that we work with, and that's what I think we had incorporated in our flagship portfolio, which is our global portfolio. So just to get a little bit detail into it, I won't go super technical, but let's just concentrate on the graphs on the bottom hand side. You see, like, and I think I mentioned a little bit briefly about this kind of methodologies that typically are followed when you go to a financial advisory firm or a bank, and you ask the advisor that, okay, I want to invest. The advisor typically asks you, are you moderate risk, or there are ways for them to determine whether you're moderate, aggressive, conservative. And typically they follow a top-down approach that, okay, you're a moderate risk, take 60% equity, 40% bonds. And because you are diversified across asset classes, your risk is managed. Typically what happens in practice is that the risk from an actual standpoint is not diversified. It varies, and you can have still a lot of fluctuations, because think of it from an example standpoint. You have $100 that you've invested, $60 into equity, $40 into bonds. Now that $100, because of market correction, has gone to $90. Invariably, that $10 loss, $9 of that loss will come from your equity, and $1 of your loss will come from bonds, right? So yes, the bonds do act as the cushioning agent, but they do the asset level diversification, but they don't really take care of risk level diversification as well. And that's why I think when we thought of our investment framework, rather than thinking from a top-down approach of traditional asset allocation-based methodology, we thought of a more risk-based methodology, where instead of thinking about moderate risk, aggressive risk, conservative risk, where your moderate can be different than my moderate, we actually wanted to quantify the amount of risk that you're taking. And that's why, we have these different risk levels, which are quantified numbers. And again, psychologically, that someone is watching over my portfolio on a daily basis. And if I've chosen, say, a 15% downside risk, that roughly translates to, me not losing more than 15%, almost 97.5% of the time, right? So that gives you a lot more confidence going into your investment, because, you know exactly how much risk you're taking, rather than, have those vague numbers per se, right? So again, I won't go into technicalities of it, but the idea is, once you can quantify your downside, what we do is, the asset allocation is the byproduct, because we target a risk level and that determines asset allocation, not the other way around. And when you do this way, what we have observed is this kind of methodology actually outperforms a traditional asset allocation based methodology, right? So when you target risk rather than target asset allocation, and you do a risk-based rebalancing rather than asset allocation-based rebalancing over an extended period of time, you see better returns for your portfolio. Right? So that's the overall framework that we work with. Now, a little bit more detailed, understanding of our different portfolio options within the global framework. We have 11 different portfolio options, and there's a little bit of a busy slide, but let me quickly run through it. The top level or the top row is basically the downside risks that you can choose from. So from 5% all the way to 25%. Then it has, some information about what is the current composition of our portfolios, and what is the average composition of our portfolios in a long-term standpoint. So if you concentrate on the middle part, which is the 15% portfolio, which is the more popular portfolios within the global framework as well, because it roughly falls, in the middle risk category, and is compared to a traditional 60-40 allocation portfolio, right? So if you look at this as well, on average, we have this portfolio having 60% allocation to equity and 40% allocation to bond and gold over a longer horizon. But again, the beauty of our portfolio is we don't follow a static asset allocation methodology. And what that means is, we really cater and, move the asset allocations depending on how risky the market is and how uncertain the period is. So essentially, I think the graph at the bottom, captures some aspect of, how the portfolios get rebalanced, especially when the market volatility and risk shoots up. So if you are choosing 15% risk, and if, for example, the market risk keeps going up, we will reach a point where, on a daily basis, when we are computing based on your current, say, 60-40 allocation, now the same portfolio, instead of losing 15% in a worst case, it can actually lose 20%. That is sort of, beyond the risk level, the target risk that you've chosen, right? It's, significantly different. So that is what actually triggers a rebalance, rather than, your 60-40 became 45-55. That triggers a rebalance in the traditional sense, right? So again, it goes a little bit technical, but I think, the idea behind this strategy is to really make sure that your investment journey is really smooth. And that's why when you see our portfolio, the golden line, the drawdown this portfolio had during the March crash was around 13% versus the S&P 500, which dropped like 34% during, Feb to March, peak to bottom. And then, of course, like the S&P 500 has had like a massive rally, and it has come back, significantly. But the fact is, because we lost so little, we didn't really need to recover that much. And that's why, like, again, from a journey standpoint, if you were invested pre-crisis versus now, you had much more smoother journey in your investment. And that's what, like, keeps a lot of people invested, rather than panicking at 20%, 30% drawdown and you take your money out, right? So I think that's the overall intent of the global portfolios in general. Does that help, Don?
Yeah, I think I'm going to answer one of the questions here as well. So an anonymous attendee is asking, should investors try to time the market when trying to go into the Syfe solution then, right? And I think the answer to that would be, you can see from this chart, if you have a crystal ball, please share that with me, because I want it as well. And I would also love to know when the downside, the crash would be, when it's going to stop, when it's going to recover, right? And I mean, I'll just share from my investing experience. It's really hard to get it right. And that's why, like, in the beginning, when I first started investing, this young, naive lady full of herself and thinking she knows everything, and just like, obviously, you're going to think that you can time it. But the truth is you can't. And even if you get lucky once, it's really hard to get it consistently right all the time in the long run. When the crash happened, I mean, let's think about it logically, right? The crash, the whole COVID-19 cases started happening in January, and then it really escalated in February and March. And then that was when all of the lockdowns happened, cases spiked, and it crashed, right? And, people, I mean, logically, if you think about it, with a second wave, and if the second wave is worse than the first wave, which is what happened with the Spanish flu, then wouldn't markets crash even worse, right? But I mean, has that happened? We don't know yet, because right now we're literally in that second wave. So we don't know. And I think no one really could accurately predict that the market was going to turn at March. I can say I was investing throughout March and April, right? And I was like, I don't even know when it's going to drop and how far down it can drop. I can try to time, but what if I run out of cash before it hits the bottom? Like, maybe it's going to be like from the peak. What if it drops 80%? So if I buy every 20% down, will I have enough until it hits the bottom, or am I going to run out halfway? And then if it turns halfway, then I'm going to be buying at a higher price instead of if I had gone down more in the beginning, in the earlier bullets, and get an overall cheaper price, right? And I think that's a problem. You see, you can't predict most of the time. So if you can't do that in the actual markets itself, then it's quite, it wouldn't be recommended to do the same on Syfe. If you find a way, if you have that crystal ball, share it with me. I want to know.
No, absolutely. I think you've covered it really well. And again, no one has that crystal ball. I think the fact that investing has now become so easy, you have a brokerage platform and you keep hearing, stories of Tesla and stuff like that. People just get swayed a lot, and they, enter and, they try to ride the wave. To some extent, they, a lot of people get lucky and they're okay. But in that sort of whole mix, majority of the investors actually end up not being on the right side. And
Exactly.
overall, it's the stock market, right? If there are some winners, there are some losers as well. So
yeah, and I mean, we can use a few examples to illustrate this concept better, right? Let's talk about individual stocks. If we just look at, say, work from home stocks, businesses that are benefited from the whole lockdown, people who invested in Zoom made a lot of money. We're using Zoom right now, right? But Zoom is not the only solution. Lots of people, especially after the recent security issue that Zoom faced, lots of corporate organizations have moved to like Microsoft Teams, even Google Meet. I have clients where they cannot use Zoom at all because it's literally blocked in their organization. But how come Microsoft and Google didn't go up as much? And then Facebook launched that whole video sharing thing as well, right? And they also didn't go up as much. How come? Why only Zoom? So can you really predict, if your belief is that the work from home trend is going to benefit this kind of video conferencing players, why is only one benefiting and not the rest? Right? So it's already hard enough. And then let's talk about, okay, so let's say then, right, what happened on the night before, during, and after the Zoom's earning was really interesting. I was watching that better than any Korean drama. And what was happening was that people was betting that Zoom's results gonna be really good. And it was, and it blew all expectations out of the water. I think it rose, was it like 30 or 40%? It was incredible, right? And then people were like, okay, so now what's the next work from home stock that can benefit from the same thing, whose earnings is also going to come out? And what happened? DocuSign that night rose 30%. I know because I was very frustrated. I was just about to buy, and a few days before I completed all of my research and analysis, and then the price ran out. I was like, wait, what is happening? And then I realized it was because of this trend that didn't even make sense. So people bought into it, and guess what? DocuSign did blow expectations as well. They had a really splendid quarter, but those who bought into DocuSign did not make money based on that. So why is it so different? Now, that's individual stocks. Let's talk about ETFs then. If you believe that buying into a diversified portfolio would work, then let's compare S&P 500 and STI index. How come one has done so amazingly well, whereas STI has been, I mean, you have still made money if you had invested in it, but obviously not as much as S&P 500, right? So it's already so hard. And I think, that's the beauty of solutions like you guys, where instead of having to manage all of that, and there's a lot of what is, how am I going to get it right, how to predict, you guys have this solution that kind of removes that out of the picture. And I think that's one great way whereby investors who are using your solution can use that to eliminate all of this what is that actually come in and really kind of like affect their returns.
Yeah, no, absolutely. And I think it's a good segue also into these other portfolios that we have, because if you're really looking to, in a way, again, the fact remains that, investment should ideally be, like simple, boring. It should just, steadily increase your wealth. But at the same time, all of us as individuals, we have our own preferences and we want to express ourselves in different ways. So that's where I think, these satellites come into play. And if you really want to, not time the market, but like, participate in the market, and you're not afraid of the ups and downs, then maybe as a small component of your overall investments, you can invest into these, sort of high growth, high risk portfolios, fully knowing what your upside and downside can be. But, there are ways to mitigate the risk of these portfolios, and maybe like, towards the later, slides, we'll cover it. Also, in interest of time, I'll just quickly cover these two portfolios that we have on top of the global core. Like, this is the core portfolio. So Equity 100 is really the portfolio that you can sort of think of when it comes to more, participation on the upside. You want to really, ride the wave of the stock market, and you don't mind, short-term fluctuations and stuff like that. I think one key feature of our Equity 100 portfolio is traditionally, most of the indices follow a very market cap oriented, allocation to the underlying sort of stocks. And what that does is, like, the largest market cap stock will have the highest weightage, and the smallest market cap will have the smallest weightage. And what we did was, like, again, we don't have an active strategy. That's why it's called a smart beta strategy, where smart beta in layman terms basically means that instead of weighing the portfolio based on market cap, based allocations, you weigh the portfolio according to certain factors that really drive returns. And these factors are not things that we have invented. These are, factors that have been very well researched and have been proven that over longer horizons, if you focus on the right factors, you can really generate, excess returns beyond what you can get from just investing into the index. And also overall your risk is sort of, a little bit lower compared to just, a market cap oriented benchmark. So I think just in terms of the factors that we consider right now is growth versus value, large cap versus small cap, and keeping the overall volatility of the portfolio pretty low. So right now, I think it's got a good mix of a good, healthy allocation to technology to give you that growth, allocation to more large cap stocks because, they, in the current situation, if you think about it, they have stronger balance sheets, more revenue streams, sustainable business models versus the small caps really struggling through this pandemic. And then just to keep your overall portfolio fairly stable, you have allocation to low volatility sectors, which includes the likes of consumer staples, utilities, and others that really help to, these are the evergreen sectors. You will always need these kind of stuff. So it really helps to make sure that your overall portfolio is balanced from a risk standpoint as well. And that's what I think it translates over a longer horizon, that your annualized returns are a little better compared to you investing just into a pure index like S&P 500 or MSCI World, and with a smaller standard deviation or risk, which basically in more finance heavy terms, it translates into a higher Sharpe ratio. So usually higher the Sharpe ratio, the better. So again, if you want to ride onto the long-term growth potential of an equity portfolio, I think this is a great option for you to try out. Now, quickly covering the REITs portfolio, I think I covered a fair bit of it earlier, but what I want to highlight is within the REIT portfolio, we do have two options. The 100% REIT portfolio, which tracks the IHS REIT Leaders Index, but the other portfolio, which is the risk managed REIT portfolio, which has some element of capital preservation built into it. And again, similar to our global portfolios, this risk managed REIT portfolio targets a 15% downside. And a lot of investors, I think, because REITs still can be fairly risky, and they want an alternative where they want to preserve their capital, but they want to get better interest rates than what they're getting in their fixed deposits and stuff like that. So I think the 50% that we have currently in bonds gives you that safety net, and the other 50% that you have in REITs really gives you that higher dividend yield, right? So a lot of, sort of investors, I think, it's very evenly distributed in terms of, how investors are investing across these two portfolios for us. And in terms of the index itself, as I covered earlier, very well diversified. People have this concern, I think, Don, you can address later as well, where, malls and offices are not, potentially doing that well. But given that this portfolio is fairly diversified across sectors, and there are some secular growth sort of sectors, similar to what's happening in technology and work from home related, things in the equity market, you have your logistics REITs, you have your data center REITs, you have your, industrial and healthcare REITs, which are on a secular, growth trajectory per se. So, overall your portfolio is fairly diversified, and, the overall returns are not that bad. And again, I think I will leave the returns part as is. I think the idea is if you want to go for higher dividend yield, you go for the 100% REITs. If you want a little bit more capital preservation and you're willing to give up certain yield for that, I think the risk managed REIT portfolio is a great option. Now, I think, what would be interesting, Don, is if you could share, if you were to create your portfolio using all the different options that we have, how will your core and satellite look like?
Okay, I'm going to pause on that first because I want to continue on the momentum you built up about REITs. So that's a really good question in there. Which actually, why are you guys all asking anonymously? It's so funny. But okay, yeah, so dear Anonymous, so that's a really good question here whereby are REITs a great investment now given that people work from home, like to shop online, is investment in REITs with malls or commercial safe. So which actually I could trouble you to go back to one slide where you actually do have that breakdown. Yeah, so I think the idea to understand here is that, look, if COVID-19 did not happen, let's face it, investments in REITs with malls and commercials were in fantastic return, right? You just look at the performance in the last few years, it's been amazing. And, people all kept saying a few years ago that REITs with malls are going to die because, everything's online. And we saw that did not happen. What instead happened was a beautiful blend of both online and offline experiences. And then COVID-19 came, and who would have expected? I mean, if you had told me even the banks, the government services are going to allow their their employees to work from home, I'll be saying you're kidding me because just look at how rigid and how strict they are about data privacy and access and everything. There's just no way. But hey, COVID-19 happened out of nowhere. None of us are really expecting it, and that just happened. So we need to differentiate between, like, you can call this a black swan event or whatever you want to term it, but no one can really predict this. And if this did not happen, these kind of REITs would still have been a great investment. Now, we'll talk about the ones that did not do well because of COVID-19, but what about the ones who have? Don't forget that your investments in REITs, such as in warehousing, people buying online, you need warehouses for these products, right? So warehouses have actually done pretty good. Your data center REITs have actually done really spectacularly well. Your healthcare REITs have also done pretty well. I think Parkway Life has been fantastic. Capo DC REIT has been fantastic. I think Maple Tree also has a data center element to it, and they've done also really well. So if you were a very savvy DIY active stock picker, then good on you if you had predicted and touched on those. I have to admit first, I think that I'm pretty good, but even I don't have the ability to have guessed that COVID-19 was going to happen and investment in REITs and malls and commercial were not going to do that well anymore, because before COVID-19, let's not forget that it was doing pretty well. So I think this is where your REIT Plus is really good, right? It's very hard to predict and get all of these things right all the time. And you guys have built the REIT Plus portfolio based on what SGX has in the iShares, and it has that exposure to Singapore REITs across. You can see the names over there, and these are actually pretty decent. Even if one goes down and is badly affected, say for example, Suntec is affected because of COVID-19, can't really do as much events as before, but you still have some of your other REITs in there that are still doing fairly decently, right? Like your Ascenders has not been hit that badly, and overall, you know, it helps to reduce your potential risk and losses. Of course, then you could argue the country is also true. You don't make as much, but the question here to ask then, if you are talking about how much you could have made, could you have actually made those moves to make all of that returns? So I hope that answers that question. REITs, I believe, are still great investments because real estate has been pretty good. Maybe it won't be as great as it was for our parents' generation, but it will definitely still have value and still go up because there's just limited land. Let's just face it. And with that alone, you combine with the different trends happening globally, REITs can still be a pretty good investment. If you don't know which one will be, then I think your REIT class solution you guys have built is a pretty good way to get exposure to that. Yeah, okay, so now that we've that out of the question, we'll go on to your next one, which you asked, how would I do it, right? So I think let's use a scenario of $10,000 because when I first started investing, it was because I had a sizable sum, 20,000 to be exact, save up. And what I did in the end was I did the active picking in the beginning, but also that's because when I first started investing, robo-advisors are not really a huge thing. Syfe didn't even exist back then. Maybe if it did, I would have taken a completely different approach. So I did active investing. I learned all of my lessons. And if I had to restart that today, what I would do is I would actually allocate 50% to my core and build up a strong base across equity, bonds, and gold. I could choose to do it either DIY or through you guys, depends on my personal priorities. So if I was in a really hectic job, like, you know, maybe investment banking, which I'll never be in because I can't stand all of that pressure. But let's say if I'm in any high pressure job or I'm really focused on taking care of my children, I don't have a lot of time to do it myself, then one good way is I would just go straight for the Syfe Global ARI solution and allocate 50% of that. So I think this answer also addresses another question raised whereby someone's asking what is the good percentage. It really is going to be very personalized because if you have, let's say, 2 satellites versus 5 satellites or 10 satellites, your percentage are going to look very different, right? But I'll just use a simplified version of 1 core and 2 satellites first to illustrate. So going with 2 satellites between real estate and growth focused companies, because growth can then go on to be huge multi-baggers. Real estate is not going to have that same kind of potential. It'll go up, but not like multi-bagger kind of potential. So what I would do is I would allocate 30% to real estate and 20% to growth focused companies so that I still get to ride on that trend without having to go through the whole emotional journey of when it goes up and down. I mean, just look at the stock price history of Amazon and Tesla and you guys will know what I'm talking about. So yeah, if I had $10,000 to start with, I would do this. Even if I didn't have $10,000, like say I only had $1,000 to start, I think the same thing can be applied because you guys have that ability whereby they don't need huge amount of capital to get started because of how you guys have built it.
Absolutely. I think this is like, as you mentioned, like a very fuss-free way for investors to get started. And if they want to implement a very simple core satellite approach to their investments, when they're just like starting off their portfolios, and it doesn't matter what amount they're trying to put in, they can get started with this and then they can sort of extend. I think like, what I did was, took this a little bit further and really drilled down into one of the clients and how, we structured the investments for that particular client. So this is a little bit more detailed, which takes into account like, what are the goals of your, the client, what are the investment preferences, and based on that, how do you design the same core satellite approach within the sort of paradigms of what we have to offer at this point of time. So for example, this particular client is aged 40, so a little bit, in the middle life, and got 20 years to retirement. And, for him, the amount that he's sort of accumulated through time is bigger, right? So, through his, income generation process, he's saved enough, but he's not done a great job in terms of investing. So he's got like $100,000 to invest on day one. But at the same time, now he's got a family to think about. Now he's got other things to, sort of cater to as well. And life is not as simple as just like, someone who's like 20, 25, who just wants to, grow their wealth and wants, easy avenues to sort of, put their money to work. They have real, goals that, they can quantify, and they want to really achieve them through different options that really align to those goals. So if you think about it, the broad level goal is retirement, but at the same time, he's also got goals like children's education, holiday home, or any home sort of down payment. And then for retirement, he wants to allocate a certain portion, which can be, into high growth companies, which is like, your technology and other sectors. And then for the retirement itself, he wants to get exposure to a certain asset class that can give him, real income as he approaches his retirement, right? So that's where I think, this part comes in as well. So if you look at the overall allocation, for retirement, he's got 20 years. He chooses a high risk global portfolio because of the longer duration versus, for children's education, it's 12 years down the line. So he chooses a more moderate risk portfolio for that. And then for the holiday home down payment, because it's going to be in Singapore dollar terms that he needs to cater to this particular need, and it's, the time horizon is much, much smaller, he might not want to take a currency risk. So the risk managed REIT portfolio could be a great alternative because it's got elements of both income and savings. And because, the down payment really is a dollar amount that you really need to have, you don't want to take excessive risk with this kind of money. So that's where I think, again, part of the core money can go into, this as well. But the fact is like, the whole core is made up of all of these diversified risk managed solutions, which overall keep your money very safe, steady, and, grows consistently. And then a smaller portion to begin with is then allocated to some of your preferences, which is like, equity 100 and REITs 100. So those become your satellites to begin with. But given that these are high risk portfolios and there is no sort of downside protection to these, what he does is on a monthly basis, he saves, say $4,000 a month. He can put $2,000 into equity 100, $2,000 into REIT 100, and just keep growing it and keep dollar cost averaging, right? So again, I think like, if you really want to do a good job in terms of thinking through your investment in a very, very, proper manner, it really can be done. And of course, like some of these things are not very easily, sort of quantified, and how do you decide what allocations and stuff like that. And that's where I think another benefit that you get from Syfe, which you don't get with a lot of other platforms, is we do have a full-fledged advisory team, which can really help you think through, what could be the right allocations for you to think about and cater to all the different goals that you have in mind.
Yeah, I think this really illustrates that flexibility of how someone can use your solutions for different needs, different goals. And one way to think about it is that solutions like you guys can fit in as an entire portfolio. I couldn't say this last year, not even at the beginning of this year, because you didn't have that equity 100 yet, right? But now with that, it really makes the whole core satellite strategy possible to do with Syfe and Syfe alone. So I think that's really one of the big game changers, because if you just wanted a super fast free way, you could just put everything into Syfe, and then like in this case of John, a sample client, your total investment size is significant. You want some kind of advice. Even if you're super savvy, you may just want a second opinion. That's when you guys can actually come in and help. And if, on the other hand, you already have certain other investments elsewhere. So I think Joseph has a really good question here. Like he says he already has the Syfe REIT class portfolio, but is not sure whether he should add the equity or the global ARI, because he already has CQQQ, OEG, as well as IXG ETFs in his portfolio to track his teams of US financial, China, and global internet. Great teams, by the way, I fully agree with that. So yeah, I think, it's like for Joseph, in his case, for instance, right? If you wanted to keep those ETFs, then you could actually just keep your Syfe REIT and your existing ETFs and have both solutions. No one's saying you have to put everything in one basket. If you're like super scared of just using Syfe itself, that could be one way. But if you value time, convenience, and effort, and you've already gone through, I think in our last webinar, I also asked you guys a hard question: what if Syfe shuts down? So you guys have a really good answer to that. People are concerned because of what happened with Smartly, right? Yeah, so if you actually really need someone to help you manage all of it, then another alternative is, would you potentially consider selling your existing 3 ETFs and moving that to the Syfe portion instead? So instead of having to manage one by yourself and another with Syfe, you could merge both, or you could keep it separate. It's very flexible. So I think that really, for anyone who's in Joseph's situation, I would imagine there would be people like that, especially if they started investing with Syfe earlier on when you guys didn't have the other solutions up yet. That could be a recurring question. So that's where you can start thinking about it. What is more important to you, to keep what you already have and you're willing to manage both of them? Or do you want to put everything and have just one person equals to Syfe manage all of that for you?
Absolutely great points there, Don. And I think over time, what tends to happen is, we as individuals, we keep trying out different, platforms, different options and stuff like that. And it comes to a time when we just have, our things spread around too much, right? And we are like, there are so many things to track. And that's where I think at some point of time, many of the clients, they value consolidation and be able to, see everything at one place. And that's where I think, a lot of clients, I think align very well with this kind of frameworks that we have built. And we'll continue to innovate, right? If there are gaps and stuff like that, we will continue to innovate to make sure that we become like the one-stop solution when it comes to investments.
Exactly. And there's really great questions. I'm hoping we can answer all of them here. But I would,
not go through more slides. I think how to get started is fairly straightforward, to go through our website and do it. So, I'll encourage a lot of, our viewers to just go onto our website, or, we have our own app and all, to and click on get started, and, it will be a fairly easy process for you to, actually navigate and, create your accounts. But let's concentrate on more of the questions that we have, and I think Don, your perspectives will be highly valuable.
Yeah, let's take the question on why REITs are not included in the core portfolio instead of satellite. So I can share my view first, and then we'd love to hear why you guys would also, to see if that aligns. So for me, right, REITs basically are not in the core portfolio because it really depends on a lot of factors, including geopolitical situations, as well as the industries of REITs. So I don't see them as diversified as, say, your S&P 500 or your global equities, or even of a lower risk compared to stocks like your bonds, or even gold, which is like a hedge against inflation. REITs doesn't really have that kind of safety. And if you look at how real estate was hit during the the Asian financial crisis and even the global financial crisis, which was actually very much triggered by real estate, right? You can actually see why there is a certain level of risk that makes it not that suitable for the core portfolio. So I personally wouldn't classify it as core. What about you guys, Ritesh?
Absolutely. I think, very easy way to understand what would be core and what would be not core is like, whenever you're talking about diversification, whenever you're talking about multi-asset class, that's where I think the core elements come into play. And whenever you're talking about a single, asset class, a single sort of, theme or a single, sort of country exposure, that's when, these fall more on the satellite approach, because, what if there is, a certain theme that is really, doing really well right now, but what if something specific happens to that particular sector or that particular theme? You don't want that to sort of derail you from your long-term investments. And that's why that falls under the satellite bucket.
Yeah, exactly. That's another good question. Whereby, hold on, yeah. So I saw someone asking, why is Syfe heavily focused on the US markets versus when there's huge potential in emerging markets like China, Brazil? I would ask the same question because previously, earlier this year, it was, why doesn't Syfe have a 100% equity question, right? So what's your take?
No, absolutely. I think the question of China and in general, a more broader allocation beyond the US is always something that we have in mind. I think we follow a very data-driven approach right now where, what we have observed is over the last, say, if you go back in history and see how the markets have performed over the last 10, 15 years, there has really been a preeminence of the US market compared to a lot of, other markets per se. And when you compare it, especially against EM markets, emerging markets, and China as well, the returns of the US market far, far outweigh the returns that you get from the emerging markets. And considering the extra risk that you're taking by investing into them, that does not compensate. So there is definitely one aspect of keeping the portfolio more diversified, but the diversification should not always come by sacrificing returns, right? So having said that, I think we are also very, very cognizant that China is the second biggest economy in the world, and it is not going to be too far away when it can be the number one economy, right? So we need to be cognizant of what's in store for the future as well. And that's where I think we are constantly researching and thinking through what would be the right way for us to structure portfolios going forward and incorporate some of these elements that have been talked about. And whether we incorporate it into our global portfolios or whether we incorporate it to some sort of satellite exposures, those are all things that are potentially options that we will think about.
That's a great one. I see another one. I think this is addressed directly at you, Ritesh. Someone's asking, how do you see the markets for next week, especially leading up to the US November
again,
election?
if I knew how the markets are going to be next week, March of 23rd, I would have put all my net worth into the market, and I would have been 50% up right now, right? So again, I think you covered it really well. If I really knew how the markets was, I probably wouldn't be in this business, right? I wouldn't be espousing all these strategies, which is, what an average investor should do. And not even an average investor, even a seasoned investor, it has been proven, and you can look at it in history, that almost 90% of active managers, they actually underperform the benchmark on a long-term basis. So rather than trying to fight the market, rather than trying to, be someone who believes that you can really do it on a consistent basis, I think it is much better to build a discipline into your investment. What that essentially means is, rather than, living week on week, live a little longer. And what that means is, follow a strategy where, think about from a proper financial planning standpoint. If you have lump sum money to invest, have these core satellite, strategies in place, save enough for your emergency funds, and then, invest the rest. And then think about the monthly income that you generate and the monthly savings that you generate. And how do you really make your money work the hardest for you? If you're going to wait for the market, you can, what happens if you wait right now and you say that, okay, US elections are coming, and post the elections, there will be a 10% fall. What happens if the market actually goes up 10%? Will you wait forever? What are you going to do? This is the same thing that has happened for most of the investors who said that, okay, March 23rd, when the market was down and suddenly the market started going up, no, this is temporary. I mean, there will be a second wave and markets will fall. But, fast forward 3 months, people are just waiting and the market keeps going up, right? So I think it is, a lot of people think it is fairly easy to, sort of predict and, take views and stuff like that. It's almost like, winning an Olympic gold per se, right? Like, people think it is really easy, but it is not.
Yeah, exactly. And so the question is not directed at me, but I also wanted to interject. I think it's pretty dangerous to invest based on politics itself. So I wouldn't usually do that. The only part where I factor in politics is when I think it could affect the business itself. So that's the only consideration, but I wouldn't invest based on if a Democrat wins versus the other team, how would their stocks fare? We could have done the same thing for Singapore general elections, right? But I think it's really hard to get that right. So anyone who invests in that is going to be hard. Then are you only going to make your moves when the market hits election season? So there's a lot of questions, and I think at the end of the day, I reach a stage in life whereby time is the most precious right now, because ever since having a kid, any spare time I have to choose, do I monitor the market so I study the business now, or do I go and play with my kid? And it's a constant struggle, right? And I believe in using time efficiently. If you want to do anything at all, it should yield long-term gains. If you are investing based on these kind of short-term general elections, kind of disease, it doesn't really hold all the time, is not consistent. I think there's better value to looking from a more either thematic approach or economic business driven approach. So that would be how I'll approach it.
Then at the same time, I guess people, as I said, all of us and including myself, we always want to sort of participate or express ourselves, right? I really believe this is going to happen, or I really believe artificial intelligence is the next big thing. And, we might have done our own research and stuff like that. And, we are of the opinion that I would participate in it, no matter what happens. So, again, the fact is, if you invest a smaller proportion of your money into that, rather than committing a huge amount, even if you don't get it right, you don't feel too bad, because it still doesn't derail you from your, overall goals. So again, things like cryptocurrency, things like markets, I would suggest put what you will call your casino money into these, which either can quadruple or go multiple times up, or be ready for it to go to zero as well, right?
Yeah, exactly. I'll take another question. I think this came in really early in the webinar. Someone asked what's the recommended composition of bonds versus equity for this portfolio be established as core for the core satellite. And I think your slide on how you guys do it in that risk approach, and then that affects the allocation, is a great answer to it. If you want to do it DIY, not through size research back approach, then the question I would ask is also very similar. What would be your risk appetite? And that will help you to decide what allocation you would assign for your own investments. There's another question whereby someone's asking, should they deploy now lump sum or deploy via DCA? We always get this question every webinar. And I'll let you go first. Richard, what's your recommendation?
Yeah, so I think overall, what we have seen from a data standpoint is that lump sum wins more number of times than DCA, because on a longer term basis, it's an upward, trending market. Economies generally grow over time. So if you invest lump sums, 70% of the time you will make more money than, you doing DCA. But, we also understand that investors in general, again, the fear of losing is, much more bigger than sort of not investing at all and getting all the returns. So that's where I think you can basically use a combination of your lump sum and DCA. And what that means is essentially, if you follow a strategy where on day one, when you're thinking about your lump sum, you're not taking excessive risk, and you are, sort of investing, taking into account what your risk appetite is, what your investment horizon is, what your financial state is, then that will ensure that you invest in a manner such that you don't really need to think about where the markets are, right? Or is this a great time to invest? And should I wait, and should I do X, Y, Z? So you can really get your lump sum invested in a much more, smoother manner to begin with. And then I think from a, again, financial planning part two, on a monthly basis, all of us, or most of us have an income. We have a monthly savings. And what we espouse again is that the monthly savings is what should go into your sort of monthly contributions into the market. And if you're really taking some high risk investments, use that to sort of dollar cost average into the market. So that really helps you sort of maximize the utilization of your money. Because the fact that if your money, the monthly contributions comes from also from your lump sum, that means bulk of your lump sum is still sitting in the bank account doing nothing and earning 0% or close to that. And inflation is much higher. So again, time in the market is much more important than trying to time the market. So that's why, I think invest the lump sum and use your monthly savings to do the sort of monthly contributions. And that I think will do wonders for you in terms of long-term, wealth building. And we did some, I think, research into this whole paradigm of, monthly DCA approach as well, where we found out that, the fact that you remain in cash versus you invest, that whole aspect itself will do a lot of change in terms of how, you end up, say, 10 year down the line, 20 year down the line. So for short term, there might be some fluctuations and stuff like that. But if you keep yourself invested, your cash will hardly grow. But, even if you get the timing wrong, we did some analysis where, you always get in at the wrong time versus you always time the market perfectly and you get in at the, sort of the right times. The fact that you are actually investing on a regular basis, that is actually going to drive returns. And, instead of say 50,000, you will end up at 70,000 versus, if you timed it perfectly, you may be ending up at like 75,000, right? So you do get a delta if you get the timing exactly right. But the bigger aspect is that if you just keep waiting, then you lose that 20,000, which you never invested.
I'm going to share an extreme example. So just to caveat this, I don't really recommend it. But, my friends actually, some of them do DCA. And I think what happened during the earlier crash this year was that when valuation started becoming really cheap, because all of a sudden the markets crashed and there was like a 30% correction, some people I knew who didn't, I must caveat this, they did not have any dependents and no heavy commitments. Okay, so money was okay, like they could afford that risk. What some of them did was they actually took a loan. Wow. In order to put a lump sum into the market at that point because they felt that valuations were cheap. And you could do that, maybe it's not through taking a loan. So that's why I say I don't recommend this. You have to assess if it's right for you. But it could also be like if you get your bonus, then you could use that as the lump sum on top of your regular DCA. If you're someone who always squanders your bonus, then you might want to commit to doing that, especially if you want your bonus to go a long way into saving for your investment. But I think the beauty of DCA and lump sum, LSI, right? I think at the end of the day, fussing between both has very little meaning in your long-term result. I think what's more important is choose a strategy that works for you. If DCA is easier because you actually can budget for it, then go for DCA. If lump sum is easier because let's say you're a gig economic worker or you're like in a property or insurance agent and you only get your income at certain stages, there's going to be ups and downs and DCA is going to be a little bit difficult for you to commit to on a regular basis, then if you have that discipline, maybe lump sum is better. Invest more when your commissions come in and less when you don't have commissions coming in. So pick the strategy that works for you rather than asking what approach is better. Yeah, I see another great question. With US market correction, what's your take on the market for next month or quarter, and what will Syfe do to capitalize on the market weakness?
Right. No, so again, I think, our approach is definitely not active. So what that means is, we won't change strategies for any of our portfolios just because, something's going to happen because of the macro environment around us, or there is some event risk that is going to happen per se. But I definitely think, if you look at what's happening in the market over the last few months, the whole rally is a little bit, disjointed from fundamentals in general. And a lot of people have a very hard time sort of rationalizing that. And I think if you look at from a market standpoint, the real drivers why market has run up so much is because of, so much money that has been printed by the Fed to pump in liquidity in the market. And most of that money has sort of ended up in the stock market, because if you look at all the other asset classes, when you're trying to invest into bonds, the yields are nothing, right? Like, why would anyone invest into bonds when, you're not getting any sort of, a decent sort of income from it per se. And when you look at your bank account, the interest rates have gone to zero. So why would you keep money in the bank account when, you're not getting any interest on it? So the only place where risk premium has remained is the equity market, and everyone has just poured in their, savings into the equity market, riding on the wave. Having said that, I think, going forward, there are elements that can be, tricky in terms of, how the markets behave over time and all, including things like, the US elections, the, second wave of the pandemic, and if the demand and everything goes, comes back or not per se. And again, those are things that will, only happen as they happen. We don't know how exactly things will pan out, but these are good, things to have at the back of your mind. And again, if you are investing for the long run, I don't think these should matter that much. Choose a diversified portfolio, choose, a portfolio that is invested across asset classes, that ensures that, like, for example, US dollar is weakening. Gold has become a very good asset class as part of your overall portfolio construction that guards against that dollar depreciation per se. And again, like, the role of all of these asset classes comes into play when there are these uncertain times, and all of these different asset classes behave in ways such that they, give you those uncorrelated returns and keep your overall portfolio pretty stable, right? So again, I think, from a view standpoint, it will be volatile. I think because, even the, bond market and all, there is a lot of bond buying program that has been happening, and the corporate bonds and ETFs have been bought by the governments and the central banks as well. I think some of these other asset classes have really got anchored in terms of pricing and stuff. So the only place where you will see volatility is the equity market. So be ready for volatility. I think, the worst, I think, is behind us to some extent, but still be prepared for all the volatility, and, make sure that you, again, invest in a manner such that you're ready to take the ups and downs of the market. And, similar to what happened, say, last week when there was a 10% correction in the NASDAQ index, right? So be ready to, face those, fluctuations in the near term.
Exactly. And I would add on, so this question is being raised by James. Instead of asking also what would the solution provider do to capitalize on the market weakness, I think I would also throw the responsibility back to us as the investor. If you truly believe that maybe the 30% drop in March or the 10% drop is a sign of market weakness and you want to capitalize on that, then you should be investing a lump sum in at that point, isn't it? So no matter what, I think the gold example is another great case study. Only recently people started talking about gold, and if you look at forums now, everyone's asking, how can I invest in gold? And then some skeptics are like, sorry, you already missed your boat. And if you had opted for the DCA approach, which is discipline, during the time when gold was not moving, you'll be like, you'll be looking at everyone else like, oh no, why didn't I invest in stocks like Tesla and the ones that ran out? I'm like stuck with gold that's not moving. But then when the tide shifts and now gold starts moving, you're like, wow, thankfully I invested regularly on a monthly basis and I have that gold exposure as part of my core satellite portfolio. So, it's very hard to predict and get it right all the time. That's the key message that I would outline. And if you guys only remember one thing from this webinar, that's the one message you should remember. So invest based on what you can manage in terms of your risk and how you see all of it fitting into your portfolio. Don't try to time the market or catch all of this. I have to admit though, I do still try, but that is a portion of my portfolio instead of everything. The danger comes in when your entire portfolio is a satellite. That's really dangerous. Then you just need a tech correction, like what happened in the last few weeks, to wipe out your entire portfolio value. But when you have an overall portfolio strategy, you're diversified, you have all of these different asset classes to protect your downside, that helps. Yes, you might not get as much returns on the upside. The more important thing is you don't lose your money, you don't freak out, you don't withdraw your investments, and therefore you stay invested in the market. So to ask our time who ask also, with passive investing, is it recommended not to check the ad as often? It really boils down on you. If you're very emotionally affected by all of this up and down movement, it's going to be volatile, right? Since February, it's already been very volatile, and I wouldn't be surprised if it is going to continue moving forward because there's just so many question marks on the macro and global scene right now. And if you are going to be affected, if that might trigger you like, oh no, it's like a 5% drop now, I had to withdraw my investment, I don't want to lose any more money, better cut loss, right? People always say cut loss. So yeah, if that's you, then don't check that. If that's not you, then go ahead and check the app.
Absolutely. Don, how are we doing for time? I think it's past 8:30. If there are more questions, maybe one or two more maximum.
Yeah. I see there's a lot more questions. Don't think we can cover all of that. But would it be better to take like the size specific questions? I think some of those might be hard to find on your website. So it'll be good to actually cover those, right?
Yeah, or we can do generic as well. What we can definitely do is a lot of site-specific questions. As you know, like we have a very core sort of advisory team. So please feel free. And I think Melvin, if you could share the link how folks can reach out to the advisory team, that will be a very good way for you to address very, very specific questions with regards to SIFE portfolios in general as well. So if you're not able to cover all the questions that we have for today, I think there is also like a there's like a link where you can get like a quick bonus if you invest. If you get started and if you finish up like a Q&A where you can also set up like time with us. So let me quickly share that screen again. So please do fill up the survey, and there is like a quick bonus that you can get if you complete it post the survey. So in that survey you can sort of post some questions as well, and plus on our website itself, like there is syfe.com. You can just go to the advisory page. So there is a link to the advisory team. So if you go there, there are ways to reach out to us through there as well. So please do reach out to us for any questions from there as well.
I see a really good question. Someone's asking, are the fees fixed for all the portfolios, and if there's going to be any transfer fees when they switch from one to the other?
Right. No, great question. So let me quickly show this. So actually, there are no other fees other than what we charge. So depending on what tier you are, you get charged 0.65% to 0.4%. So if you invest less than 20,000, then it is 0.65. If your total account value is 20,000 plus, then it is 0.5%. And if you invest more than 100,000, then that is 0.4% per annum. And by the way, it actually covers everything. So there is no trading or brokerage cost. All rebalancing is done free of cost. All dividends are automatically reinvested. There is no entry exit charges. There is no lock-in period per se. If you want to switch from one portfolio to the other, yes, you can do it 100%. And there is no switching charges as well.
Okay, I'm going to take there are personal questions here, so I'll talk about that. So some are asking if I'm invested in SIFE, how much and in what portfolio. So that's very personal. I'm not gonna give, and the reason why sometimes I don't answer these questions so directly is because I don't want people just copying the portfolio. That's going to be the worst mistake you can make. But you see, it happens so often. I've seen it happen with other investment figures that I follow in the scene. When they talk about this stock tip, everyone rushes in to buy, and it doesn't really fit their investment horizon. So I always urge people and my readers to make your decision. So let me talk about how we approach it. I'm not invested in my personal portfolio, but that's because number one, I started investing before SIFE was up. Right? And number two, when SIFE first started, they only had one main solution. It took time before the other solutions were actually launched. And as I mentioned earlier on, if I could turn back the clock and restart my investment journey, I would not have gone straight to active investing because I had painful losses and lessons learned during that period. I would have just gone straight into a core satellite approach with SIFE 3 solutions here, and then have another portion of cash for me to learn active investment, because that's where my interest and my passion lie in. I actually quite like watching this kind of video. Just yesterday, I wanted to I was thinking, okay, I'm gonna watch Hua Mulan, the animated show, because I wanted to compare to the movie, right? But then I got distracted because on YouTube, there was this recommended video that came up to me, and it was a 30-minute video on how a company that I'm invested in, the title was How This Company Makes Money. And I got completely distracted by it. So I stayed up late watching that video. It's actually something that I like. I don't even realize that time passes. So because of that active thing, I'll have to say in my personal portfolio, I would never go with a fully passive approach. It's just not me. It doesn't fit my personal objective. But for my child portfolio, I'm looking at it right now because it's on my whiteboard. I do have my child's portfolio for me structured in different ways. And where Syfe is fitting in is primarily also one solution, I won't mention which. I'm using one of Syfe's solution to fulfill that portion of needs portfolio. The only reason why I haven't looked at the other ones as well is because I already have some strategies and movements that were made way beforehand. So I hope that helps to provide you guys with insight as to how you should be approaching this. Don't just do it because I do it, right? And then you would never invest. Does that mean if I tell you today that I invest in Disney, which I am, you're gonna go out there and buy Disney? It doesn't work that way. You have to work based on what works. And that's why we spent a lot of time in this webinar on this collaborated blog post explaining the strategy and how you can arrive at that step-by-step process to decide if that strategy and solution is right for you. So I hope all of these case studies have helped you guys. And this sharing, I didn't answer the question directly, but I think there's a lot of hints dropped there. So you know what I'm driving at, you would know what I mean. So use that to really guide your investment decisions. And I think, at the end of the day, I really like the Syfe solution. I have to say that because for those of you who have been following me since my blog first started, you know that I'm super selective of who I work with. And when Syfe first reached out, I was honestly very skeptical because at that point, there wasn't much solution. But I took it up because I wanted to understand how did the strategy work and was that something that I could also agree with. And it was, I don't work with every robo-advisor. I don't work with every solution provider. But the ones that I do is because I truly like the way that they strategize and come up with solutions. The solutions at the end of the day is just one thing. To be very honest, if you wanted to copy wholesale, right, you could just go on the Syfe website right now, look at what are the REITs that they're invested in the REITs Plus portfolio, and just copy that by yourself. But what's more important is understanding why the REIT Plus portfolio solution could be a good solution for you, which is what we're covering today in terms of time and convenience. And you can always copy, but if you don't know why you're buying, you also wouldn't know when to exit, when to sell. And that's going to be a problem in your long-term investment. So that's where a solution provider might help and go out there and explore the different solutions. But I think today's session has been great for most of you, I hope, because we'll talk about how you can use the cost and light portfolio strategy, what is that all about, how you can apply it to your investment. We'll talk about different ways you can do it, DIY assisted as well as through Syfe, as well as how each of their solutions can actually fit in to help you achieve that core portfolio. And I know there's a lot of other questions that we didn't get to talk about in this webinar. We'd love to answer all of that. But for Syfe-specific questions, please go ahead and ask. Speak to Syfe advisor. I think it's great that you guys have that advisory function. Not all of the solution providers that I've explored actually offer that. So people, if you guys have questions, just go ahead and ask Syfe, and I'm sure they'll be more than happy to help you.
Thank you so much, Dawn. It's been an absolute pleasure to be, speaking with you. And thanks for being such a strong patron as well. And we look forward to working with you again.
Same. I'm hoping that you guys will launch more satellites in the future. So it makes the whole core satellite even more exciting for people who have different thematic approaches or beliefs. But I'll be watching this space to see what you guys can do. And yeah, I'm sure everyone else here is.
Absolutely.
All right.
And thank you again so much. Thanks everyone for joining in today. And as we mentioned, feel free to reach out to us through our advisory channels for any questions that we might have missed.
And don't forget to use the promo. So as per my usual beliefs, I actually did not opt for an affiliate. I could have, but I don't want to because I don't want to let it skew the decision. You should not be going into just Syfe itself because there's an affiliate which will benefit me. I want to keep it as objective as possible. So I'll just make it very clear, okay? If you guys sign up with Syfe today or not, I don't make any money out of this. So go ahead and make your decision. Do not be swayed by any affiliate, or because you're like, oh, I want to give Don some bonus. You don't have to. Make a decision that's best for you. Speak with the Syfe team, and if you can really see the value of what we've been showing you through this webinar, go ahead and speak with them to explore how the solutions can fit into your portfolio. If you have any other questions, you can always reach either of us, Syfe on their different channels, or even myself on Instagram or anywhere else that you want to find me on.
Great. Thank you so much, Don, once again, and have a good night, everyone.
Thank you,
Don. Bye-bye.
Thank you.